Welcome to the February presentation from Areté Wealth Strategists. I am the founder and principal of Areté Wealth Strategists Australia, working with Australians in America and Americans in Australia. Let us get started here. So no presentation would be complete without the usual requisite disclosures. This does not constitute personal, financial, tax, or investment advice, and it should not be relied upon as such. You would be well advised to seek your own tax and financial planning counsel here. Let me see our YouTube channel. I'd encourage you to visit our YouTube channel, take a look. We've got many dozens of videos tackling all manner of interesting topics that Australians in America and Americans in Australia face. You might also want to take a look at our website, where if you click under the Knowledge Center, we've recently done a major refresh there. We've got a number of white papers available. You can find all the webinars that I just mentioned a moment ago, and a number of new blog posts are available also. A little bit about me. So how did I come to be involved in this international and cross-border financial planning space? And the answer is simple. I was born into it, tri-citizen of the UK, Australia, and the US. I have lived in the US since 2005. I now live between Australia and the US, spending 7 months of the year in Australia, 5 months in the US. There's a little bit more about my background. I've really been in the industry for the past dozen years. I've been a conference speaker, blog writer to one of the best known financial bloggers out there, Michael Kitces, and spoken at a number of conferences. Some examples of the kinds of issues that we assist clients with would include Australian business owners living in the US. Here's a case study, a high net worth family currently living in the US looking to move abroad, and an Australian executive family permanently relocating to the US, so getting set up. So there's an example of the kinds of things that we work with our clients on. But let's get into it. So here's the topic for today's presentation. So first, in fact, this is going to end up being a multi-session presentation because there's so much to get into in this presentation. But let me first start by outlining what we're going to go through. So the benefit of receiving stock awards or equity compensation. What's the point at all? Why does this exist? We'll talk about the four most common types of stock awards, the growth potential and how they differs between the different types, the differences in taxation from a US point of view, international issues with stock awards. So there's a whole manner of different concepts that we'll need to introduce there, including taxation of foreign income, where we talk about the foreign tax credit, foreign earned income exclusion, and how tax treaties play a role in determining who gets to tax what. And then lastly, we'll finally get to the substance of today's presentation and the advertised topic, and that is to do with multi-year compensation arrangements and how they're handled internationally with their taxation. So let's just look firstly, before we get into talking about stock awards and their benefit, I wanted to draw your attention to a graphic that we commonly use, and that's one you can see right here. So in the inbound pre-move phase of an expat's life, we can see at the bottom there, tax departure planning. Why does that show up? Well, it shows up because in the case of an executive who was perhaps granted stock awards in Australia and then moves overseas, unbeknownst to them, they actually do have a filing requirement on those positions because of the way that the stock is taxed internationally, which is quite a complicated topic. So there's tax departure planning. We see in acclimation to the US, many executives that we work with are granted stock options or other equity-based forms of compensation. So getting their head around that, it's much less common in Australia, unless you're working for one of the major tech companies here, but it's much less common in Australia. And excuse me, on the outbound side, preparing for departure, there's a lot of tax planning involved there. What to do for the executive who's granted options in the US is going to be working in the UK or Australia and continuing to vest in those options or RSUs before they're able to sell them or exercise, as the case may be. So I think the takeaway from this slide really is that tax planning is critical when options or any kind of stock award are involved. Okay, so you've heard me use this term stock award, equity compensation interchangeably, and they really are. And it's the cover-all, it's the umbrella term to talk about major kinds of stock ownership in a company. And we're going to be focusing really here on RSUs and stock options. They're by far the most common forms of stock awards that we see. So how did they come to be part of a common remuneration package? And the answer to that is, well, simply, it ties an executive to that company. If there's a vesting period, then they're not going to receive a payout unless they stay for that period of time, but also it aligns their thinking with driving value for that company. So that's the whole point of equity-based compensation. Companies may also grant stock awards to lower-level employees to incentivize them to take ownership. That was what I just mentioned. With with stock options, given the leverage, the inherent leverage in stock options, you see that typically granted more towards the higher-level executives who are in a position to influence that company's direction and value a little bit more. So that's what you see here. Stock options go to senior executives, lots more growth potential, but conversely, they can expire worthless. So they may be coupled together as part of a package of RSUs as well. So that's something to keep in mind. And we've seen a big correction in the fintech sector in the US in the past year, where option holders would be missing out, whereas RSU holders are still getting something for their company service. So the four basic types of stock awards we're going to look at here include stock options. And stock options, you can and should and probably have read a white paper or very long description dealing with what stock options themselves are all about. So stock options is fairly complicated. The idea is, as I've written right here, it's essentially a contract between the company and the employee that grants the option holder, namely the employee, the right, but not the obligation, to buy, and I've crossed out to sell because you're really not going to be selling or a put option on a company that you're working with. You're hoping it gains in value, not loses value. So we want to have an employee that's granted an option to buy a share of a company's stock for a pre-specified price for a specified period of time. That set price is known as the exercise price. And so at exercise, the option holder must come up with the cash, or they can do what's called a cashless exercise, but they must come up with the cash in order to buy the options. And then once they own the options, buy the stock. Then once they buy the stock, they now own the stock. And that will be day one of ownership of that stock. And so we get into a whole complicated area to do with ISOs versus NSOs. We're not going to go into that. That's a little bit too complicated for our purposes here today. But there are in the US, there are two different types of options. There's your qualified option type, your ISO incentive stock option, and your non-qualified stock option type. And it really has to do with the taxation of that so-called bargain element of that option. So the stock owner now must hold that stock for a period of at least 12 months, and then they will get long-term capital gains treatment from that, and life is good. So they get long-term capital gains treatment and can sell. So what has their experience looked like overall? They were granted options. Rarely folks, do they have to buy the options? Normally they're granted the options, but then they have to buy the stock. So then they'll buy the stock at that pre-specified price, hold it for another year, and then if they hold it for another year, that is going to get them at a minimum long-term capital gains treatment on the difference between the purchase price of the stock and the selling price of the stock. And if the options granted were a type called an ISO, an incentive stock option, then that would get them up to $100,000 per year of long-term capital gains treatment on what's called the bargain element of that particular stock. Okay, most companies have and option grants have a vesting schedule. We're probably pretty familiar with that concept of a vesting schedule. The idea being that you work for a company for, let's say, 4 years, and it's on a level vesting schedule of, say, 25% per year, then what we're going to see is that over the first year, 25% of the options are now available, second year, 50%, so on and so forth. That's a vesting schedule. And now options also have an expiration date, and that's an important distinction versus stock. Once you have stock in a company, provided that company doesn't go bankrupt or merge or get well, even if it does get delisted, it doesn't matter, you still have your stock. The fact is, stock itself doesn't expire, but options do. And why is that? Because you have reserved the right to buy the stock at a pre-specified price for a period of time. Now, oftentimes the expiration period is about 10 years. It sometimes can be shorter than that, but typically you'd see 10 years for that expiration period. And the vesting schedules can vary. They can be cliff vests, they can be level vests, or some other combination thereof. Okay, so cash needed to buy the stock. This is another financial planning consideration that clients need to be mindful of, and that is the options themselves may be given to you, but to buy the shares, especially if you're talking about the kind of multiple that you see with options, what they allow you to buy, you may need to come up with tens of thousands of dollars to actually execute on that stock option and buy the stock itself. So how do you do that? Sometimes the company will loan you the money. More often than not, what we see people doing, which is not a great tax move, but it's the best of available options, is to do what's called a cashless exercise. And a cashless exercise looks like this. Let's say you have 1,000, I'm just coming up with an example off the top of my head, 1,000 options. Those 1,000 options are worth $50,000 worth of stock. Then what you're going to do, if you need to come up with the $50,000 worth of stock, so I'm getting lost in my example here, you're going to need to sell this, you're going to need to exercise and sell a certain amount of that stock immediately to generate that cash. So you might not be able to realize the full $50,000, but by exercising and selling immediately, you have the liquid cash proceeds in order to perform the stock exercise, the option exercise. Of course, the whole point of options and why they're used as incentive compensation in the first place is that the owners of a company, the directors of a company, are trying to incentivize senior managers who are in a position to leverage additional value from that company. And so the idea is, by giving them options, which themselves, the options may not be worth that much, but they could buy a given amount of stock that is a multiple of the dollar value of what the options themselves are worth. And so if they pay off big time. And if they don't pay off, they don't pay off at all. I will flash forward to another interesting and somewhat obscure and off-topic point here to do with this. And that is, when you're in periods of high volatility, options can in fact be a terrible form of incentive compensation if the company ends up tanking. And the reason for that is the taxation of how those options actually work. So there may be some income recognized from the grant and the vesting of those options. However, when an exercise or before an exercise takes place, maybe that stock craters below the exercise price, which means they expire worthless, and yet tax has had to be paid on the imbued value of that option that was granted and vested. That would be a really bad outcome if you have to pay tax on something you never actually received the benefit of. So the intrinsic price is the difference between the exercise price and the market price of the stock. So to come up with an example, we need to illustrate an example, we need to use a few different data points. We need to say what the exercise price is. Let's just say, for our example, it's $5, and the market value of a stock is $10. Now, those options may be worth $1 per option, and the option gives you the right to buy the stock at $5. When the stock is trading at 10, what do we have? We have $5 of intrinsic value, the difference between what you're able to buy at and what you're able to sell at. So there's that's also, this example illustrates where the multiple effect, the multiplier and leverage effect comes in, where if your options are worth $1 each, and you're given a material amount of options from your employer, let's say you're given $20,000 worth of options, well, those $20,000 worth of options can indeed be, there can be a significantly greater multiple of value than what the taxable basis of the options was in the first place. So options, oh, here we go. Look at this. An example, a hypothetical technology company grants stock options to their employees. They may purchase shares in the company at $25 a share by a certain date and time. The current value of the company is $20. The options presently have no intrinsic value. They're $5 out of the money. In 4 years, however, when the options are fully vested, the market price of the company's shares is $80, which suggests that if the employees exercise their stock options and sell and buy the stock at that market price, they stand to make a paper profit of $55 at that point in time. Of course, merely buying the stock need not equal an actual, let me correct, sorry, there's a glaring error that I see right there, and sell their stock. We want to say, and buy the stock, actually, because they're merely exercising the option results in buying the stock, not selling the stock. They make a profit of a paper profit of $55. Now, if they own it for another 12 months and that stock goes up to $100, then they've made a combination of gains. There's the bargain element, the difference between the $20 and the $55. Then there's another element of gain there between the 55 and the 80. And then there's the difference between the 80 and the final value that they sell the options for, they sell the stock for. As mentioned a little earlier, the employee will need to come up with the cash to purchase the option in the first place. Okay, next type, we've got restricted stock units. Actually, it's just restricted stock units that we're looking at here. Restricted stock differs in that someone actually has the stock and may have dividend and voting rights preferences with that stock, but RSUs, on the other hand, until they vest, they don't actually, they don't convert to stock. They don't have any voting rights or dividend rights either. So employees are granted shares of stock upon vesting or other requirements being met, mostly performance standards. I would say the majority of the time I've seen this, it's simply a period of work. You work at a company for 4 years and it'll vest 1 quarter per year, for instance. Depending on the value of the stock at the time it's granted to the employee, the company may decide whether to grant the value as shares or as a cash equivalent. That's rare to see. I haven't seen someone grant, or a company grant the shares in cash instead. Typically, they just grant them as shares. And then once they vest, the way that the taxation of that works is it's simply ordinary income compensation in the year of vest. So there's a lot of intrigue and mysticism, I'd say, around stock awards in general. And I think that's well-deserved when it comes to stock options. RSUs, on the other hand, are pretty straightforward. It's as if you had been paid in cash, but you hadn't, you were paid in stock instead, taxed just the same. Oftentimes, the way that the tax on this works is that the employer will withhold a given number of share units, convert that to cash, and pay that to the IRS. And withholding, that's what you would commonly see. So a lot of folks ask, is there something that I can be doing to improve my tax position with these RSUs? And the answer most of the time is no, other than the typical end of year moves that we recommend for our clients. So once that stock is held, it's simple capital gains or loss tax rules apply. So that is, hold it for more than a year, you get long-term capital gains treatment, or sell it within a year and it's treated as short-term capital gains, which is ordinary income rates. So stock appreciation rights, what's this? This is otherwise known as phantom stock or synthetic stock. The idea here is that a company is not actually giving stock itself. What they're doing is they're using the share price as a measurement tool. And so they're saying, if our stock increases in price, we're going to pay you the cash amount of that increase. That's what a stock appreciation right actually is. So they're very simple to get your head around. It's basically just cash that's paid to you as a function of the movement of a stock price. Stock appreciation rights come in two flavors here. We see the full value or appreciation only. Typically, it's appreciation only. And that's, as I mentioned a moment ago, that would be when there is an appreciation in price. I've never seen a company ask for a refund from an employee if their stock price actually declined, however. So there isn't that symmetry, that perfect symmetry. Okay. Moving on to number 4, employee stock purchase plans. Now, these are great. Whenever I see these in place, I say to my clients, this is wonderful. It's free money. Take it if you can. Now, it's not always free money, I should say, because it depends on a company basis. But most of the time, what you see with employee stock purchase plans is an interesting formula. And that formula would be, you employee may purchase company shares at the lower of the value at the beginning of the period or the ending of the period with a 15% discount. So to my way of thinking, it's simple. You get the lower of the two. So regardless if the stock was trending up or down, you get the lower of the two, and then you get 15% off of that as well. What's there not to like about that? To me, that's free money. If you turn around and sold it straight away, you would still be in the black given that 15% discount that the formula has used. Does that make sense? Am I recommending that? Absolutely not. I think your circumstances are unique and you need to consult with a tax professional and a cross-border financial advisor that understands these situations to figure out if that's appropriate. One of the factors that comes into it is the concentration risk of that owning that concentrated stock, that closely held company position in your overall net worth. And sadly, as I mentioned earlier, with the fintech correction that's happened in the past year, we've seen certain individuals who've had a lot of their wealth tied up in company stock see that decline significantly. And so that's what we're trying to avoid by diversifying that risk out and owning the broader market. We're minimizing that risk, that company-specific risk. Okay, so what accounts for the increased interest in and use of restricted stock over the past decade or so? And I'd say it really comes back to a couple of things, and that is the complexity of managing stock options, the understanding by executive teams and directors that stock options really have this more, I shouldn't say exclusively, but have more of an all or nothing tendency to them. There's a great quote from Bill Gates where he talks about swapping from primarily using stock options in the early 2000s to using RSUs now. And he says an executive at Microsoft would have been in a position with the performance of how Microsoft stock has gone, where they may have been given a generous stock option grant and then been able to buy 5 dream houses and send their kids to college 50 times over. Or if the stock hadn't performed and the options expired worthless, then the kid ain't going to college and there's no dream houses being bought, excuse me. And so what you see is this huge multiplier effect. And so wanting to stabilize for that, we've seen, and also to avoid the instance of where stock options expire worthless, we've seen a greater use of RSUs. But all of this spells the need for planning, and especially when we introduce a cross-border element to all of this, and we need to be mindful of a whole range of different topics that I'll be going into in a moment. So the growth potential. This kind of comes back to the point I was making a moment ago. So options, you got the leverage of the option, often a similar dollar value grant. Let's say you're granted $50,000 worth of options versus $50,000 of RSUs. That option has got leverage built into it because there is an exercise price, and the options themselves may have a multiple. You can buy X number of stock at a given price. They come in all different shapes and sizes. RSUs, you're really looking at the growth of the stock. In owning that stock, you'll be exposed to the dividends. That's great if the company pays dividends, and also capital gains tax treatment. So a bit of a discount there on capital gains. SARs, really, that's not as good because you're not receiving an asset. You're just being paid an amount of money for it. So it's ordinary income treatment. And ESPPs, I meant to mention a moment ago, excuse me, that they're typically limited to $25,000 per year. So while it's free money, while I love them, they're not nearly the sums of money that you see with folks that own significant RSU or option packages. So it doesn't end up being quite as much, but thankfully, not only do you have that 15% kicker in the formula to your advantage, but you've also got dividends and long-term gains, long-term capital gains treatment on those holdings. Now, this is where things can possibly get very interesting for a non-US person who is perhaps thinking about leaving the US, moving back to Australia, and they own these concentrated positions. And the reason that's interesting for the temporary resident, the visa, the E3, the H1B, the O1, the L1, those types of temporary visa holders, is because they're not going to retain an incidence of US tax residency upon moving back to Australia. What does that mean? Australia says, welcome back, mate. Great to have you here. I see you have these stock holdings here. What's the basis of that? What should we begin to tax you from? We don't really know. So we're going to say it's the fair market value of that stock today. And if there's already been significant appreciation in that position before returning to Australia, that could be a very, very happy and homecoming for that individual. So differences in taxation. All right, we've got the ISOs versus NSOs. Not going into that today. There's too much detail there. RSUs, ordinary income taxable when vested. I mentioned that earlier. Short-term, long-term capital gains rates apply when the stock is sold. Generally, where it makes sense in your overall situation, and you're not too concentrated in that particular position, we would say hold it for a year if we're optimistic about the company and the economy as a whole. Stock appreciation rights, plain taxable income, nothing more to be said there. ESPP, limited to $25,000 a year anyway, and this has to be paid out of payroll, so there's a cash flow implication there, and often a discount formula applies. You've heard me say, short-term, long-term capital gains rates apply when that stock is sold. All right, so we're going to get into a lot of complicated issues here to do with stock awards. So here are some concepts that we're going to introduce, and we'll get into this in greater detail in part 2 of this presentation, where we go into the international taxation treatment of them. But firstly, we need to understand some basic things about stock options and stock awards before we can, excuse me, let me start that sentence again. We need to understand some basic things about international taxation and global mobility before we can talk about the international taxation of stock awards. Okay, so let's get started with that. The first thing we need to understand is legal residency versus tax residency. So US immigration laws have distinct definitions of residency when compared to tax laws. We see legal residency, there's really 4 types of legal residency. You're either a citizen, a permanent resident, or on your way to becoming a permanent resident. It's known as a conditional resident. You're a non-immigrant, i.e. a temporary resident. That's someone there on a visa, for instance, the ones I mentioned a moment ago. Or you're undocumented. That's it. These are the 4 legal residency categories. What do they have to do with tax residency? They have, it's kind of like the Venn diagram. There's a bit of an overlap, but it's not perfect. In other words, you can be in the US illegally with no documentation at all and still be a tax resident, as crazy as that situation sounds. So, tax residency, here's the thing to know. If you're a citizen or legal permanent resident of the United States, no matter where you are in the world, if you're in Antarctica or Zimbabwe, anywhere in between, you are a US tax resident. And what comes with that are all the informational filings that are required with that, and an annual tax. You are assessed for tax annually above a de minimis amount. Now, whether or not you'll end up owing tax is another matter, because there's a whole range of mechanisms that exist to counteract double taxation. But in either case, it is extremely burdensome. Let's just say that it is burdensome. Next concept, source of income. The source of income is to do with which country, really, where income is deemed to come from, hence the source of the income. The source country determines which country gets first taxing rights on that income. And whether, as I mentioned a minute ago, whether any income is actually owed to another country or not depends on a whole range of factors, namely the relative tax rates of the US over that source country or resident country. Great example of this I love to go to is British Virgin Islands, Bahamas, Bermuda, UAE are places where there's very little, if any, income tax at all. So how would a US individual be taxed in those countries? Congratulations, they're still a US tax resident, and so US tax rates will apply. There is still one little advantage they would get, and that would be the foreign earned income exclusion. They could take advantage of that, but seeing as they're not paying any income tax, there's no foreign tax credit to take advantage of in the first place. Of course, each country we need to look at individually to see if there's a tax treaty in place, and that's going to govern this in further detail. Okay, you heard me mention foreign tax credits that may eliminate or offset in the foreign earned income exclusion. In 2022, that's up to $112,000 may be completely excluded from US income. However, the bad news is you get above that 112 and your tax rate doesn't begin at zero. No, it kicks in at exactly the applicable amount that would apply at $112,000 depending on your tax filing status. Okay, let's use an opposite example or a different example. We'll talk about Australia. So in Australia, we have higher federal brackets and they kick in earlier than what we have in the US. Okay, as a result of that, if you're an American in Australia or an American tax resident, a US person, as I like to say, in Australia, then you're probably not going to end up owing the IRS any tax on that earned income, with the exception of superannuation. And that's a whole nother topic for another day, because the IRS looks at that tax deferment made into superannuation and it says, we don't know what this thing is. You call superannuation. We don't recognize it. We think that that's taxable income. Thank you very much. Does it actually end up getting taxed by the US? Not often, because of what I'm alluding to here, the difference in the marginal rates. And it would be a very helpful graphic if I had a comparison and could line up, in fact, I can do this. You may have to use your imaginations very slightly here, but let me go to my key financial data sheet and I'll show you exactly what I mean. So that's just loading right now. We see here are the 21-22 Australian tax brackets that are in effect for the current tax year. So you see 0 to 18 at 0, and then it's 19 to 45. Above 180, you're at 45%. Don't forget about the Medicare levy. So that brings you up to 47%, but it's called a levy, not a tax. Is it dealt with in the tax treaty as a result of that? I would say no, it is not. However, consult your tax counsel on that one. Okay, so here are the rates. Here are the amounts where these rates kick in, and here are the amounts of the tax that is due. If we compare that to the US rates, well, firstly, we have to compare it to a number of different tax filing statuses, because in Australia, we don't have tax filing statuses. Everyone's pretty much an individual, even if you're married or a survivor or whatever the case may be, doesn't matter. Everyone's single. In the US, however, you see here the rates are doubled for married filing joint. So not only are the rates lower, maybe not at zero, they're not lower, given that Australia's are in fact 0 up to 18,200. But for most everywhere else along the scale, it's the amount of tax is higher and it's kicking in sooner than what it is in the US. By and large, for the addressable client base that I'm often talking to, I find that they're making above $180,000 equivalent in the US. And so they would be in a much lower tax bracket if they were to compare their income from one country to the other. Let's go back to the presentation. Okay, So applicable tax treaty is another thing we need to look at. So source of income, really, we're trying to make this point very clear about source of income. The idea of which is income comes from a given country, and that country has first taxing rights on that income. And what we see is, in the case of Australia, if someone owned an investment, they were living, a couple living in the US own an investment property in Australia, real estate income, rental income is deemed source to the location of this tangible real property. And so the Australian Taxation Office is going to have first taxing rights on that property. Now, what do we know about this? This is where I love the complexity of what I do. This is where we know for sure, or I know for sure, that that individual is not going to have to pay tax in the US. And why is that? Because the only other rate that Australia has is the non-resident rate. So you're either a resident or a non-resident. They don't care if you're single, married, widowed, whatever. Doesn't matter. You're either a resident or a non-resident. And what we know is that if you had any income at all, it's taxed at 32.5%. Now that is higher than 0 or 10% that we see from in the US. In fact, you have to get all the way up to making $340,000 married filing joint before you're even approaching the same tax bracket. So that's my interesting little aside there, and it also accounts for why I'm so bearish on so-called investment property that Australians in America hold back in Australia. Okay, now here are some other things that we're going to get into and go through this very quickly, because as I mentioned, this is a enormously complicated topic. Typically involves a referral to a tax attorney when someone does have equity compensation that's vested across borders. But before we look at some of these issues very briefly, let me go through the common consequences of being a US tax resident abroad. So firstly, there's the reporting issues and filing. Reporting and filing is really what that should say. You're going to have to file and you're going to have to report. The penalties for not reporting on these things are absolutely horrible, especially if it's deemed willful. It's shocking. We're talking about 50% in the case of FBAR, willful non-compliance. We don't like that at all. I also don't like PFIC, passive foreign investment company issues. What's that mean? This came about at the 1986 Tax Reform Act, and it was essentially where, in order to level's the wrong field, it's more like disadvantage the competition, European and overseas mutual funds could roll undistributed earnings within the mutual fund until a sale event happened of that fund. And that gave a tax advantage to those funds because they weren't paying tax on an annual basis. So what did the US do about that? Did they say, that's a really great tax approach for investors, we should do the same thing? No, they said, instead, we're going to slap a penalty on anyone that owns anything that we define as a passive foreign investment company. And what is a passive foreign investment company? There's a broad, I could get into the definition of that, but I've done a whole nother webinar on that. You're welcome to go check that out. I believe that was September 2019. But you don't want to own a PFIC is the bottom line. You're going to get taxed at the highest marginal rate that existed at that point in time. And even worse for some, for lower account balances, would be the tax filing requirements. And the tax filing, who would think that the tax filing could be worse than the tax itself? Well, until you see that the IRS estimates that it takes 10 hours to do the proper reporting per PFIC, it's only then that you come to understand that these are bad news and you don't want them in your portfolio. So if you're a US person, a US tax resident, I should say, so either in the US or a citizen or permanent resident abroad, you now need to be mindful about any ETFs or managed funds that you have in your portfolio, with the exception of certain superannuation accounts. And I've done a separate webinar on that too. So go check that out if you're worried about PFIC tax treatment on your super account. Benefits of a tax treaty. So that's all well and good, the benefits of a tax treaty, but they don't apply to US tax residents. Why? Because of this beautiful thing in the US model treaties. And that is, they say they have a savings clause. And the savings clause means we're going to save any US tax resident from being able to partake in the benefits of the treaty. We're really just going to tax you as if you're a US tax resident, regardless of whatever the treaty says. So that's why when I talk about opportunities that exist in the tax code between the US and Australia, I really call it out to those that aren't permanent residents or citizens, because you can't partake in that. Why? Because of the savings clause. You're still deemed a US tax resident. So that's not very nice at all. Tax treatment of foreign retirement plans. I alluded to this a moment ago. And then net investment income tax. I'm going to have a drink of water because I feel like a horse racing announcer here and talking through all of this stuff so quickly. So taxation treatment of foreign retirement plans. Really, they're going to be treated as employee benefits trust or a foreign grantor trust. Foreign grantor trust equals bad. Employee benefits trust equals less bad. Net investment income tax. Now, this is a clear example for those higher income earners who are subjected to this of double taxation. And that's because this is not a tax. This is like one of those fees and levies, things that they don't use that cute word tax for, or they use a cute word that's not tax for, that is not covered in a tax treaty. So higher income individuals do end up having to be to pay the net investment income tax. Treatment of foreign trusts is really going to depend on the kind of income that comes from that trust and where it's sourced to. And now you're educated on this concept of source. So you'll now have some idea of what that means. Controlled foreign corporations, we're going to keep this really brief because remember, I'm really only enumerating this list today in order to get to the point to do with stock awards and equity compensation and how that's taxed in a cross-border context. So businesses are also bad news for US tax residents. Why? Because, or businesses abroad are bad news. They're great news in the US, just not abroad, because of the CFC rules. It essentially says if a US person or people own more than 50% of a company, it becomes a CFC, which means that they need to be assessed, that's right, assessed on the total income of that company worldwide, even if it's undistributed, which creates some horrible circumstances because you've got undistributed income and taxation on income that was never distributed. So really a kind of phantom tax. Not fun at all. And the oldie goldie, the Hart Act, the hero's earnings repatriation tax. I've done a couple webinars on this. This is definitely something to look out for Americans that are thinking of relinquishing their citizenship, or permanent residents thinking of surrendering their green cards. The hero's earnings assistance and relief tax of 2008 essentially provides an exit tax for those deemed covered expats who leave the US global tax net. So not a pleasant thing at all. It's really not a single tax. It's not like this monolithic single tax. It's really the application of 5 different types of taxes to someone's global net worth. So we're talking about money in superannuation accounts, money in the couch cushions, collectibles, everything. If your net worth exceeds the easiest test to meet is the $2 million in global net worth. And if you meet that, then you have to go through this whole rigmarole and determine if you owe an exit tax to the US. Okay, so now we're moving on to another set of topics, tax treatment of non-US citizens. So really for US tax purposes, this beautiful, charming word that they use, alien, falls into one of 2 categories. And that is you're a resident alien, that is you're a permanent resident living in the United States, and their tax treatment is really the same for all intents and purposes as a citizen. Not exactly the same, there's some gifting things that are a little bit different, but mostly for tax purposes, without getting into transfer tax, that's the world of gifting and estate planning. It's the same. It's the same. Someone might come out with some obscure example, but I can't think of anything that's different if you're a permanent resident versus a citizen. And congratulations, that also means because you're a permanent resident, you're going to be taxed on everything worldwide until you submit this form I-407 and you're done with the US and you wipe you're done altogether. Now, they might not be done with you, you might be done with them, That's where it goes back to the Hart Act. We're not going to go there today. That's going down a complicated rabbit hole. Okay, or you're a non-resident alien, and non-resident aliens are really, it's pretty straightforward. You're simply not in the US, or this bullet point A here, or this item A, is really saying you're not considered to have passed a residency test, an immigration residency test in the US. So non-US citizens are automatically considered non-resident aliens unless, so if you're an Australian who's in America and you're on holidays and you haven't stayed for 183 days, or it could be less because there's a sliding scale formula they use looking back, then you're not a US tax resident. They'll say, fair enough, you weren't here long enough. Or if you have a green card, congratulations, if you have a green card, see, non-US citizen, but you have a green card, you're a US tax resident. Non-resident aliens are taxed only on their income effectively connected with the US trade or business, and to a limited extent investment income from US sources. I hope you can see why we have gone through this in the detail that we have, introducing all these concepts, because source of income, tax residency, immigration residency, you cannot begin to have an educated conversation about the taxation of stock awards until you understand these things, because they're foundational to the international tax concepts. Situs of assets, and we're not done yet. Situs of assets. So now what does a situs mean? Situs is Latin for position or site. It means for the purposes of estate, for transfer tax purposes, for gift and estate tax purposes, where is an asset thought to live, exist, or its site, its position. Generally, tangible property located in the US is considered US situs property. So intangible assets are a lot more complex than that. Doesn't make a whole lot of sense. We've had tax attorneys on through the GFP Institute, another organization that I work very closely with, and they have said, good luck in trying to figure out where or how or why certain things are deemed to be US situs and certain things are not. So some things do make a lot of sense. Real property, if everything I've seen, real property is thought to be situs in the country of origin. And that just makes sense. It'd be kind of weird if you said, hold on, that rental property that I've got that's in Melbourne is sourced to the US. Well, that doesn't make sense because it's in Melbourne. It's there, it's physically present. Personal property, a little bit different. So we've got dollars and other currencies. Now that is so weird. I have no idea how this came to be, but when we say dollars and other currencies, we mean hard cash. We mean bullion. We mean dollar bills in a safe, not dollars in a bank account, because for reasons I can't describe, that's not considered US situs. Okay, personalty is, that would be those cars, art, collectibles, things located in the US. Although there's an interesting aside to that I'll save for a different time, and that's to do with these art storage venues that aren't technically considered to be in the US, even though they are in the US, that the ultra high net worth benefit from, but that's another story for another day. So what is US situs here? Stock of US companies, I think that makes sense. They're in the US, they're listed on a US exchange, fair enough. Private debt issued by corporations, I believe that's just by US corporations. Cash value of a US life insurance policy. This makes no sense at all. So take a look over at what's not US situs. So you'll see here, death benefit of a US life insurance policy. This is where we need to get into even more fundamentals. So when someone dies and they have a life insurance policy, if it happens to have been a permanent life insurance policy, there'll be a combination of the amount paid out that's considered to be cash value, like an investment component of that life insurance policy, and a different amount that's deemed to be the pure death benefit of the life insurance policy. The death benefit is not considered US situs, so you don't have to worry about US estate tax issues there, but the cash value component is considered US situs. I have no idea how these things came to be. I've been told it's just the lobbying strength of different organizations here. Business investment assets, they're considered the US situs. Annuities, qualified retirement plans are all US Situs. What's not US Situs, US listed ADRs, that makes sense. American depository receipts. This is where you see companies that have what's called a dual listing. They present in both countries. And so their primary, let's say BMW, for instance, is a company with an ADR in the US. It's mostly traded in Germany or Bayer or any number of other European Siemens, mostly traded in Germany, but they have an ADR in the US. American depository receipt. So fair enough, its primary listing is on a foreign exchange. It would make sense that it's not US size. Cash and demand deposits held in checking or savings accounts. We just saw in the previous slide that cash itself is US situs, but cash in the savings account or checking account is not. I don't know why, but it's not. Stock of foreign companies, fair enough. Publicly traded bonds beats me, especially when we look over here. We just saw private debt issued by corporations. Apparently that's US situs, but if it's publicly traded, magically its situs changes to be non-US. The death benefit of a US life insurance policy, that goes to, if you've seen my presentation on the do's, don'ts, and maybes for Aussies in America and Americans in Australia, that's where I would say you want to get your life insurance in the US because it's cheaper. Death benefit's not considered US situs, and it's advantageous. Sorry, I was distracted there momentarily. Offshore mutual funds, well, that makes sense as well. They're not on US territory. Taxation of foreign income. So what do we have here? We're going to do a short look. I'm looking at the clock and I'm mindful of the time here. On these three concepts, I really am not going to spend much time on the foreign housing exclusion or deduction, simply because there's not much to say. But the foreign earned income exclusion, let's look at that. So taxpayers can make use of the foreign earned income exclusion either through the physical presence test, i.e. spending more than 330 days outside the US during a 365-day period, or through the bona fide residence test. Only allowed on foreign earned income. Now, this is the thing. Can you use the foreign earned income exclusion on your Australian aged pension? No, because it's not earned income, not earned. So therefore it wouldn't apply. Income is earned from employment typically. It's 112,000 this year. The reason this comes up, why it's an important concept, is because in the case of stock awards, is what if you find yourself overseas, somehow you're still able to vest into your stock awards, and that does happen. It's not often, but sometimes you've seen that for senior leadership. They'll continue to vest even after they've left. What happened, and they weren't earning any other income in their total taxation. They could say, well, I'm going to exclude a given amount of income. I'm sorry, I'm getting my wires crossed. Forgive me, that example. Sorry, it looks like the internet just cut out for a moment there. But the foreign earned income exclusion is an important thing to understand with regards to how the US will tax a US tax resident who's overseas earning money. They're going to exclude the first $112,000. Is it always the best way to go? No, it's not. Foreign tax credits can actually end up getting. US has to avoid double taxation. It applies basically to any country even if the US doesn't have a tax treaty with them, except candidates, Venezuela, Cuba, North Korea, Iran, etc. But provided we're not talking about those countries, if you have paid a foreign tax on income that you've earned, then the US will say, gosh, you've got a foreign tax credit for that amount, and that's going to reduce dollar for dollar the US tax that would have been assessable on that same income. Okay. Operation of the foreign tax credit, only income tax is creditable. This is not for any tax at all. A capital gains tax, for instance, would not be applicable necessarily. Let's see. So US income tax, if the income had been earned in the US, this is called the limitation. Federal income tax Australia can reach 45%. If the tax on the same income is 37%, you forfeit the difference. Tough luck. And this is the thing, it took me a long time to get my head around. They say, but it's okay, that excess unused credit can be carried forward for up to 10 years or carried back 1 year. Nice, but think about this. Unless you plan on moving to the UAE or the British Virgin Islands, Bahamas, Bermuda, any of these other low or no, Hong Kong, Singapore, low or no income tax countries, then I would put it to you that that tax credit is essentially suspended. You're not gonna ever be able to use it, because so long as the Australian tax rates remain above the US, and that's likely for the foreseeable future, you will never be able to be utilizing, you will never be able to utilize that credit while that delta exists. Okay, foreign taxes for which you can't take a credit for include those ones right there. Just in the interest of time and leaving a few minutes for questions. Operation of tax treaties. We're gonna round it out here today. Operation of tax treaties. So tax treaties are the ultimate resource for understanding the taxation of assets and income between two countries. It can be broad or narrow, but you'll see that in tax treaties, it deals with personal services and investment earnings, and stock awards are certainly have characteristics of both of those forms of income. Some treaties include tax benefits that must be claimed. Treaties utilize verbose technical explanations to clarify the legalese and jargon and ambiguous terms that they use, and they're full of them, I might add, in them. So looking at technical explanations can really help with that. I mentioned I'd finish up the savings clause, with the tax treaties. Let's end it here with the savings clause for today. I've already alluded to that. Just in the moments that we have left, I wanted to see, just answer some questions. So, Yer, hi Yer, I hope you're well. I hope things are going well for you in Europe, if you're still in Europe. Do US ADRs avoid PFIC considerations? Yes, they do, because why? Unless it was some sort of listed investment company like a Berkshire Hathaway or something, because the operating companies themselves don't pass the definition of PFIC. They don't have more than 50% of their assets held for passive purposes, and not 75% or more of their income is producing passive income. They're operating companies. So BMW is making cars. Siemens is making all kinds of different things. Rolls-Royce, they're making jet engines and cars again. Bayer, chemicals. So they're not investment companies, and that's where the PFIC rule would trip them up. Q&A. Okay. Jake, thank you for attending. It's a pleasure to have you here. Can you have the slides? Unfortunately not. This is made available to clients only, or in the case of GFP members, if you go there on the GFP side, then we would share them there as well. Anonymous writes, I might have missed this due to connection issues. Why can the foreign tax credit not be used if the Australian tax remains higher? Does it not roll over year to year? I apologize, anonymous attendee there, because I think the internet may have cut out for a second. The issue is to do with the fact that the delta is always going to exist, or as far as I know, as far as anyone can predict, the US rates are going to be lower than the Australian rates. And so long as the Australian rates are higher, you're simply going to accumulate that foreign tax credit. The only situation where I could see you being able to use them would be if you moved to a low or no tax jurisdiction and said, hey, I've got all of these foreign tax credits that I accumulated back when I was working in Australia, and now I'd like to put them to work and save me some taxes. That's the answer to that question there. Anything else? Any other questions, concerns, doubtful points right now? There's all the slides on multi-year compensation agreements we'll get to next time. And that really leaves us here. If there aren't any more questions, and I'll come back, see if for one last round that I would like to say, if you want to learn more, please go to our website, click on Get Started, and it'll talk about what next steps actually look like. We could schedule a 15-minute call, see if we may be able to assist. All right, any other questions before we sign off here today at what is going to be 12:30 for me on the dot? Doesn't look like it. Okay, well, thank you, everyone. You have a wonderful day, and thank you for attending. We will be, I will be more accurately, hosting part 2 of this next week, and we can, excuse me, next month, and we will go through this in greater detail. All right, thank you very much.